So, hi everyone. So welcome to our fourth lesson in investment analysis. And I hope you got a good understanding of whatever I taught so far. So today we will be actually covering kind of like a different area in investment analysis. So before that, I thought it would be good if I could kind of skim through what we covered during the last three sessions. So, yeah. So let me share. Let me start sharing this properly so that you can see the content well. So, yeah, hold on, guys. Okay. So, what were the things that we covered during the last three sessions? We covered capital structure. If I remind you, we spoke about equity, about debt, how the capital structure works. We even spoke about how the risk, the cost of capital changes for each section. Then thereafter, we moved on to specific sections of capital structure. So initially we spoke about bonds, and then we spoke about equities, and then the derivative futures options. We just kind of covered everything that generally comes into a capital structure actually, where we talked about the instruments which would have a risk involved, and how the companies decide on investing on a certain category, like whether they would decide on equity, whether they will decide on uh, derivatives or like the debt capital actually. And if you remember, we actually did a little bit on the uh, a bit of whack as well, I believe. And then we also spoke about the efficient market hypothesis. We did like a small introduction of it. And then we went on to regulation on trading securities and things, but they were all, they were done briefly so that we can move on to today's lesson. So they were actually part of like brief introductions for today's today's sessions and probably next week's session. So I just hope that you got a good understanding about different capital structure, components of capital structures and different types of securities. Um, so that was what we covered during the last 3 weeks. And today we will be talking about investment theory and the financial services industry. So before we were actually talking about a company and how investment is done, those kind of things. But today it will be mostly on the theory of investment as well as the industry and how the financial services industry kind of works. So in this particular lesson, which would probably be covered in 2 sessions, we will be kind of including things such as the concept of investment. Now we are talking, this whole module is investment analysis. So we need to understand what the concept of investment is, right? So we will be talking a lot about the concept of investment here. And then we will move on to something called market efficiency. So basically in the last session, I think we spoke, like skimmed through a little bit of market efficiency. I just spoke a little bit. And then today and either today or the next week, we will be covering money market investment and how the companies can invest in the money market, and also talking about the yield based securities and portfolio management. So the thing is, this particular session actually we have kind of done a little bit about the yield based securities you would, if you remember what we covered during the last 3 sessions, should remember that we did some calculations on yield and spoke about derivatives and things as such. So here we will be talking extra, where we will be talking about yield basis securities, and we'll be also talking about portfolio management as well. Now here, so what is expected from here? What is expected is the knowledge of investment and the portfolio management will be expected here. So basically this expectation is obviously a little different. However, what I've prepared is I've tried my best kind of to cover everything in your learning outcome in through these lessons, because instead of just covering what is there, we've prepared separate lessons which includes areas in which all these module content or module outcomes are included as well. So under this particular lesson session, we will be having several sections. So as you can see, we will be talking about the concept of investment. So what investment is, we'll be talking about that. Thereafter, we will be talking about market efficiency, what market efficiency would mean, and what money market investments are, then the yield basis securities, as well as talking about risk. So when I talk about risk, you will obviously remember if there are risks. I mean, obviously we'll be probably talking about different securities and, you know, talking which securities would have a higher risk and which securities have a lower risk. That would obviously be covered, you know, talked about, obviously, because in investment analysis, obviously when you're investing, one of the main things that an organization or investor has to look into would be risks, because if there is a high risk, the return has to be high as well. So then we will be talking about risk, and we will also be talking about portfolio management. That is obviously we'll be talking about how, you know, how an organization need to balance their organization, or even a person. This might apply to even a person who is investing actually, where they need to decide on the weightage and how they invest in different types of securities. So during the last 3 sessions, we had been talking about different types of securities, talking about different methods, yeah. And then we were saying even in debt, different debt, bonds and derivatives and so on. When I were talking about different things, you would have understood that even in a, let's say if you take a derivative, it could be secured, it could be unsecured, could be redeemable, it could be unredeemable. That means when it changes, obviously the risk, of course, the risk change as well. So that means when a company is investing, having a portfolio of different securities, they need to decide which securities need to be invested in which weightage. They have to take the best suited set of securities. So that is like one of the most important decisions that investor does, or like, you know, the finance section would be focusing on while financing to the company. So all these things will obviously be covered here in this session, as you can see. And so moving on, we'll just talk about investment. So the concept of investment. So what is investment? So what is exactly investment? It is basically, you can say, an asset or even an item which is kind of purchase with the hope that it will generate some kind of income, or like could be something which would appreciate in future. So that is an investment. So basically investment, when it comes to even a person, what we mean by investing is, okay, when a person is going to, let's say, invest on certain, like, let's say it's a person who is okay, a person who, like me, who is tutoring. So that a person who is tutoring, if that person invest on, obviously, on a laptop or things such as that, what is the intention? Obviously, to generate income, or also thinking, okay, right, it would appreciate in future. This is not the best example, but I just wanted to, kind of give you an example of something that we actually know. Just, but when it comes to a company, if you look at a company, it would be all the machinery that they invest on. When they buy a machine, what do they do? Think, okay, right, while buying this particular machinery, we will generate some kind of income. Example, when it comes to an apparel factory, when they invest in certain types of machines, what they think is, okay, right, we are going to invest on this machine in order to generate income. Or it could obviously appreciate in future as well, but that doesn't work too much when it comes to like something which generates income or has rent as well. However, so there should be some kind of income that comes in to whoever is investing. So this could even be like, investing in a company, right? So investing in a company could be also an investment, because at the end of the day, what the investor does is invest in a shareholding or anything of that sort, and accept some kind of income back. So basically, that is what basic investment means. So when we look at the economic sense, so investment is generally purchasing of goods or services which is not consumed today but are used in future in order to create wealth. So that is what is meant in the economic kind of sense. You need to understand that. But basically talking something, buying something, thinking, okay, right, it will give us some sort of income. And then also, okay, right, if it's something which would appreciate in future, you think, okay, right, I would gain something out of buying this machinery instead of, doing, investing in something else, right? So in finance, basically investment is like a monetary asset, which is purchased with the idea that the asset will provide income in the future or will be sold at a higher price for a profit. So basically in finance, as you can see, it's some kind of monetary asset, obviously an asset which is monetary, and this asset will probably provide income in the future or will be sold at a higher price for a profit. So basically, as I told, it could be something like investing in some sort of security. Okay, you buy the particular security thinking, okay, right, it would provide income in future. Okay, there could be sort of like an interest that comes in, or even appreciation in the value, where the person can obviously sell in an year or so. If it's like a long-term security, where you could sell it in an year or so in order to gain some kind of a capital gain. So this is what the concept of investment means. And actually, we've been talking about all this during the last 3 sessions. We've actually been talking about this. So I just wanted to, instead of moving towards, because we're talking about investment, wanted to kind of start with the basic and try and understand what the word means and then move on with it. instead of just moving on talking about the concept. So when it comes to investment, what is the basic objective of an investment? Now, when it comes to investment, what do you think is the main objective of any person in investing in anything? So number one, it's a source of an income. Yes, obviously, will a person just, invest on something, not expecting anything back? No. Obviously, a person invests on a security or machinery, expecting some kind of income and some kind of benefit. It could mostly, when we are talking about finance, it would obviously be monetary benefits. However, it could even be non-monetary benefits when it comes to individual things. However, even those non-monetary benefits could be calculated in a monetary way. If we look in a finance perspective, that is how it is. So basically, why do we invest? Invest because it would be a source of income. So shareholder invests expecting their dividend, their source of income. A debt holder, why do we invest in a debt? Derivative, debt bonds, euro bonds, all sorts of funds. Why? Expecting the interest, as well as obviously the capital gains. Those are things that is expected. All of them are income. So thereafter, another objective is a method of saving fund in safe and secured options. Okay, right. So if we have extra money, so before talking about a company, I just want to talk about, individual kind of perspective so that everyone would understand what I'm talking about, right? When it comes to a person, what do they do? If they have extra money, they would look into banks and say, okay, right, I this extra money, what do I do? Do I waste in food and different things, or do I just save? Do I put it in a bank and do I check how much interest it has and how much? And when I'm putting my money in a bank, it's a safe and secured option rather than just going and investing in something else. So obviously, why do people choose things like banks? In a basic sense, everyone kind of in their extra savings are put in a bank because they think, okay, right, this money is safe. One of the reasons. Similarly, when it comes to any other derivative or bond or any other type of investment method, one of the things that a person or a company, here it would be a company, they would be looking into an investment option just to make sure that the money is safe. Okay. Also, another basic objective is as a medium of growth of capital. Okay, why do you say, investment is a medium growth of capital? Why do you say that? Why? Because see, as I explained to you before, when we invest, do we invest thinking, okay, right, I have 10,000 pounds. When I put it when I put it in a bank, do I expect just the 10,000 pounds back? Do I expect only that? No, I put it because I have some sort of, interest or some kind of amount that I get back, right? So why do I put my money in a bank? It is because there would be a growth of capital, correct? So the only way a person would only if a person keeps the cash at home, the money would just be as it is. But generally people don't do that. They will find some kind of investment. And when they are doing it, they will looking to see whether they are getting something back. So when they get if they're getting something back, that means there will be a growth of capital. So through investment, one of the main objectives would be to kind of have, get back an increased amount of cash back, or there should be some kind of capital gain or interest or something of that. And it is also a method of minimizing taxation. Now, why do we say investment would minimize taxation? So one of the methods of investing is investing in the debt capital, right? On debentures and all sorts of debt capital. When we do that, if you remember correctly, from the last 3 sessions, I've kind of explained to you how the interest rate that we receive is tax deductible. So while you're paying in the income tax, that particular interest is tax deductible. Therefore, if you remember, while we were talking, calculating even the cost of capital, we are, can you remember in certain sections, we were just talking about equations where I included 1 minus t before taxation and after taxation. And I said the cost of capital is why less? Obviously, because the risk is less, so the cost of capital is less because of the taxation minimization. So one of the objectives of investment is minimization of taxation. Thereafter, it would be marketability and liquidity purpose. So why do we invest? Because it's marketable. And, so basically, why do we say it's marketable instead of if we have some sort of debt or like shareholding or something of that sort, obviously, that could be sold and could be kind of sold, and the cash could be received to liquidity purpose instead of investing on something else. So one of the main things of investment is to the marketability. To have the basic objective would be marketability and liquidity purpose. So now we are also going to talk about the motives of investment. So what are the motives? We are having a renewal of worn out assets. So why do we invest? Obviously, when we have worn out assets, obviously we have to kind of invest to either, to buy new assets and make sure that the new assets are in place, or invest in kind of, making sure certain worn out sections are replaced. Okay, one of the motives. And then acquisition of additional assets to expand the business and increasing the output. Obviously, that is one of the things that we talk about in investment appraisal, where we always try and invest in some kind of asset which would increase the business value or the output, like the machinery I was talking about, like for the apparel industry, and to innovation to reduce costs and or to create new value. Obviously, to have this innovation to reduce the cost and to create kind of like new value, and in order to have a periodic income flow. Obviously, why do we invest? As I told you, if we invest in debt capital, what do we get? We obviously get the interest annually. So that means there would be a periodic income flow. So obviously something that that is a motive of investment. And so another is to acquire capital gains. Obviously, you buy at a certain rate and sell at a certain rate, which is higher, and then through that you gain capital gains. So this also have been talking. And then to achieve social benefits through various investments. Obviously, to kind of get some kind of social benefits, investments could be used as well. So now when talking about the concept of investment, we are going to talk about the investment cycle. Now, what is the investment process cycle? Okay, so this is basically part of this financial evaluation of the project. Because, when it comes to the investment evaluation, the financial evaluation, there are certain steps that are considered in a project, and that's how the finances are evaluated. So, so generally, when it comes to investment cycle, it generally would cover things like the period, and it usually, when it comes to the investment period, it would obviously be several business cycles, like it would obviously be something which is a certain number of years, right? When we invest, it would have a certain number of years, which would include several business cycles. And another thing that we need to understand when it comes to investment, what happens is initially at the beginning itself, do we generate cash flows? No, obviously not. First, you invest on that particular investment. Thereafter, we'll move on, and the company would kind of start generating cash flows at a certain period of time. Thereafter, they will be generating their cash flows. So that is kind of like the investment cycle. So basically, when it comes to the investment cycle, what we need to remember is that it obviously, an investment has a certain number of steps that is used in financial evaluation. And when it comes to the investment, there is a certain, a number of years, that's a cycle. And obviously, at the beginning of the investment, you're not going to get any cash flow. You're going to get cash flow, obviously, after a certain number of time. So thereafter, I will be, now what is investment cycle? You would have wondered, what is she talking about? Is she just jabbering? Same thing. So what is investment cycle? Let me explain to you what it is. So first, when it comes to a company, what a company does is it tries to search. It could be individual as well. Okay, we are going to talk about a company perspective, because obviously we are going to talk according to the companies. However, it could be in personal as well. So we will be kind of looking for different investment opportunities. If the company has enough cash to invest on something, they will look into different investment opportunities, list them down and see, okay, right, now this extra money we have, where do we invest it? Which method would give us generate more income, which would have a bigger income? So then first what happens is, current will search for investment opportunities, right? And thereafter, and then while checking these investment opportunities, we also have to look into would be the company strategic plan. So can a company who is like focused on a certain set, okay, when there's a strategic plan in a company saying this is what we are going to do, the investment opportunity, even if it's something which generates a lot of income, they need to, they can't just choose on it, right? It has to be something which is in line with the company's strategic plan, the long-term plan. So when it comes to investment opportunities, obviously, what the management does is they look into all the opportunities and see list down. And then after that, obviously, with that, what they do is, okay, they look in and see, okay, right, is this according to the company strategic plan, what our plan is in long term? And if it's so, yes, those things you kind of take in. That is what happens here. And then a project. So like project in outline. So then the projects will be selected, and there will be an outline that will be kind of created where like different things will be questioned, like what are the assumptions, what are the key factors that need to be considered. Those will be kind of, more things will be kind of included in the selected sets of projects. Okay, saying, okay, is it according to the plan, and what do we need? What are the things that we need? What are the extra HR things that we need? And how things will work out. And then thereafter, the project will be financially priced. So when it comes to the markets, the macroeconomic production, everything will be kind of appraised. One of the methods that you need to understand is when you're financially appraising, obviously different investment appraisal methods might be used, like the NPV, IRR, um, the payback period. It could be PE ratio, it could be sensitivity analysis, anything could be kind of used according to what type of project they are and which method would be more suitable. Sometimes they might even, select all these investment appraisal methods and just kind of check to be appraised financially to select on the best suitable project. Okay, and then the project would be authorized, including the capital budget. So now you need to understand, initially, we can you remember when we were talking about control, what did we talk about? We talked about budget, where we say we put in something in the budget, thereafter we appraise the budget. So even when it comes to concept of investment, when you're investing, first, what an organization would do when it comes to a project would be, they would be budgeting the capital and to see, okay, how much money do we need? How are we going to spend it? What are the things that we need to move on with? So you need to understand that budgeting is also very important when it comes to investment appraisal, because it's more related to kind of like monitoring. So thereafter, monitoring. So the feedback will be kind of monitored, and thereafter, using, as you can see, using the budgets, what we do is we control the actual against the plan. So obviously after that, what happens is you put in the budget, and then after that, the activity kind of happens. After a particular period of time, what the company does is they will go back, look at the budget, and compare it with the actual and look at the variances. See whether it is an adverse variance or a favorable variance. And then if there is anything, so after, so based on that, the project will be kind of reviewed. The implementation will kind of be reviewed to see, okay, what went wrong? Was it because of some external thing, or was it because of some kind of financial thing? So external, or it has to be internal. So just check on it, and then thereafter again, if there is any need, what they do is they will look in for further opportunities if they keep on having extra money. So that's what generally happens. That is the investment cycle. So you need to understand one of the reason I started off with the first lesson where I was talking about capital budget. If you kind of, it is because it's one of the most important things that are needed when it comes to investment. Okay, so now we're talking about investment cycle. So as I told you, first thing is to gather information. So information regarding the activities such as like external information, identification of opportunity cost, and the historical cost to make prediction and even to make decisions. Different information will be kind of collected initially before investing in anything. So first step is obviously to gather information. Thereafter, it will be to build prediction. So what is building prediction? This would generally include like assessment of like the costs and even the benefits with regard to a project. Like example, a feasibility study would kind of help to understand the benefits and the cost involved with a particular project, like potentially viability of the project could be understood through this feasibility study. So predictions are very important for an organization to kind of like do an investment, right? Just because you gather information doesn't mean that the company would just budget and kind of, invest on it. They have to make sure that what they're investing on is correct. So obviously prediction will be built upon, and it would be checked to see whether it's correct. Thereafter, the project will be accepted. So after gathering information and building the predictions, what happens is a decision will kind of be made whether the organization is going to go ahead with the project or not going ahead with the project. So here, not only a financial evaluation, other things like social, technological, ecological factors will also be taken into consideration. So you need to understand when it comes to financial, like when it comes to a project, it's not just financial evaluation, because you need to look at to the social, all the macro economical factors as well, because when you're kind of investing on something, all things would come into play. All the macroeconomical variables will have an effect in your project as well. So when we are going to do it, just the financial evaluation, which is kind of like internal, is not sufficient. These things also need to be considered as well. So thereafter, the implementation happens. So when it comes to the implementation, the project would generally be divided into kind of like two stages with like respective deadlines, where the roles and responsibilities, two targets would kind of be established. So that there will be two stages. One is when the roles and responsibilities will be to the target would be established. Thereafter, the resources will be provided for each stage to work, for the works to be done. The roles will be included and targets will be included, and resources will also be allocated according to the work done thereafter, so that the project would properly be implemented. Thereafter, evaluation of the performance. What happens is, at this stage, the monitoring happens. So the actual progress which is planned would be compared here, compared to the budgeted, as I told. So the variances will be kind of identified, and like a post-completion audit would be kind of performed, and like corrective actions would be. So what happens is, as I told you before, the variances will be identified, where they would see, okay, right, how much have we budgeted in for this particular project and what is the actual amount. The comparison will be done and the variances checked. Or if by any chance the variance is high, like the adverse variance is high, then what they do is there will be a post-completion audit performed in order to see what went wrong, and then the corrective action will be taken. So it should be noted that the control action would also be taken on time in order to minimize any negative impacts on project deliverables. Sorry. Okay. So when it comes to the deliverables, the negative impacts will be kind of minimized by using different control actions. So evaluation of the performance will be done using a budget. Thereafter, using the knowledge gained of the evaluation, the project will be developed, delivered to expected benefits, and assessment will be done. And what was, whatever went wrong, and what went wrong, and what contributed to the success, and how this delivery could be improved in future project. All the knowledge gained through this project will be used for the future projects when it comes to investment cycle. So those are the steps. And I need to talk about post-completion audit. So we said during evaluation, if something goes wrong, what did I say? There would be a post-completion audit. So now, because I use this word post-completion audit, let's see what post-completion audit is. So when post-completion audit is kind of like an audit which is done for the entire project after project is kind of completed. So what happens is like it would include a lot of detail and depth, like it would have more emphasis on like improving the management, like when it comes to like the future project. So post-project audits are more long-term oriented because it checks like the performance of the project. But the audit represents like a broader view of like project's role in the organization, because through this, what we're actually doing is we are trying to see what went wrong, and then that whatever the learning is will be incorporated in the next project or the future project. So as you can see, there are few things that will be identified through a post-completion audit, as you can see. Like one of the thing is the extent to which the quality was achieved. So they will obviously check whether the quality that was expected is whether it was achieved, and the actual cost of the project and comparison to the budget cost will be done to identify obviously the variances to see whether it's adverse or favorable and things as such. And the actual time taken to compare the project versus the budget time will be taken. So just like the cost, the time taken in, will be actual time will be compared to the budgeted time to see whether all the activities were completed in the timeline given, or whether more time was needed in order to achieve whatever was in the project. And if so, why there was a high, if there was like if a higher period was included, then obviously there will be analysis into why more time was taken in. Was it because of internal issues, or was it because of some external kind of reason? And after an analysis of problems encountered in the project and effectiveness of solution would be put forward. Obviously, when things like what are the problems that happens, and what are the effective solutions that were put forward during those problems, those will also be considered, and the effectiveness of the project management process used to manage the project will also be included. So if the methodology was not perfect, the need to change or modify it before the next project is required. So what the post-completion audit does is it kind of does like, post-mortem of what happened in the project and try to see, okay, right? First, it would just say, okay, is our methodology correct? The method that we use correct? If not, it needs to change in our future project. And also with that, if not, they will try to identify the tiny things which went wrong and how it could be minimized in the future project to increase the efficiency and the effectiveness of the investment. Okay, so now we'll be talking about linking investment in IT, kind of when it comes to IT with strategic, operational, and control needs. So one of the things that we need to understand is IT, or information system strategy, information technology strategy. Those are like very important things when it comes to investment. So when it comes okay, now normally when it comes to an organization, it would have 3 different strategies related to information. So one is called information system strategy, which would include all the hardware configuration. So, and also like transfer of information of things as such. When it comes to a company, obviously, we live in a digital era where the companies need to, move towards a more IT based system. So one of the things is the information system strategy, which will have all the hardware configuration as well as the how the transfer of information happens. Thereafter, it would be the information. So also this information system strategy generally relates to like the long-term plans concerning the IT of the organization. And when it comes to management strategy, generally deals with the like the deals with how the data is organized or stored and things as such. Hold on. Okay, right. So as you can see, the management strategy, as you can see here. So when it comes to the system strategy, it's basically the hardware configuration and how everything kind of happens. And when it comes to the information system strategy, okay. So when it comes to the management strategy, what happens is it generally has all the data which is stored and how it is kind of, that is what management means, right? So that will be used. And also one of the needs that we need to understand is IT is something that was used in the past to kind of computerize back office functions such as let's say stock control accounting. So here what happened was, the best that was happened was that, hold on. Sorry about that. So one of the advantages those days was that, increasing in the operational efficiency with like the cost advantage. So, however, so those days, the IT was kind of used at an operational level. However, now it would add value for customers because everything is changed. A strategic advantage could be gained by using IT to kind of differentiate the computer services and company services. So therefore, the IT is like a very big investment to any organization because that would give that competitive advantage to the organization to stay in line with any organization in the market. So when it comes to information management, a company basically will have like professional who would have like good insight into like the business, or when it comes to the strategy, the IT strategy, which will be like basically be the basic strategy, the business strategy actually. So because IT is kind of that the function which enables business strategy, it kind of helps the business to achieve a sustainable competitive advantage at all levels of business. Because IT involves in business strategy, obviously that competitive advantage will be achieved through this use of IT in information management. And now we're going to talk about what do we do before implementing an IT strategy. So before implementing an IT strategy, it's very important for company to kind of assess the cost and benefits involved in a new strategy. So like when it comes to it, like future, when including a lot of IT, what happens is a lot of future upgrades would be required when it comes to the systems of the automation and stability needs to be improved. So when an IT strategy is included, obviously all the new IT gadgets need to be taken in order to make sure that the strategy is properly kind of included as well. So now we actually need to talk about market efficiency. So efficient market hypothesis is something that I've actually talked before as well, right? So as you can see, market efficiency generally to extent is generally like how how much information which is used in order, it's built upon like the shareholders, share prices. Like when it comes to share prices, it will just kind of be dependent on the demand and supplies. And according to the efficient market hypothesis, uh, there are 3 levels of market efficiency. This I think I explained to you before as well, where the weak form of efficiency is when in the efficient market, only like when let's say it's the situation where like only all the historical information is captured in a share price, like when it comes to the like historical trends of revenue and profitability, only those are considered. Then uh, if those are only captured in the share prices, that is considered as weak form efficiency. And then there is semi-strong form of efficiency. So when it comes to the semi-strong form of efficiency, what happens is the market is not just, it doesn't only include the historical information or the public information, which implies like an investor will have both types of information. It would also, it would, okay, now in weak form of efficiency, only the historical things would be included. Here, historical information as well as public information, which is kind of like the current thing, will be included. And an investor with both types of information would not be able to make a gain in this particular market. Okay, so this is kind of like a semi-strong form of efficiency. And the strong form of efficiency, according to this, is the form where historical information, when it comes to here, like when it comes to the historical trends of revenue or even the profitability, as well as the public and inside information, both are all available. And in however, in practice, inside information should be legal in most markets. So it would be less practical. So basically, when it comes to strong form, not just the historical information and the public or the current information. Here, strong form is when the inside information is also kind of included, captured in the share market price. So that is efficient market hypothesis, as you can see. And now we need to kind of move towards money market investments. Actually, this is a large area which we need to kind of move on with, because it talks about all the markets, as you can see here. However, what I would do is I will start off with this because we need to kind of move on with the lessons. I will just start on with the money market investment. We'll kind of do like the basic of it and then move on to the real different types of markets and things as such during our next lesson. So first, we'll be talking about financial markets and types of markets. So what is a market? Market is basically any kind of organized kind of system which connects a buyer as well as a seller. So when it comes to financial market, this is a market where buyers and sellers who trade in financial assets. So like any type of securities which are financial. So there are a number of ways that we can use in order to kind of classify the regard to financial market. And it could be captured below. So you know what a market is, and as you can see, this is the financial market, is where a market where buyers and sellers will be kind of trading financial assets. And when it comes to different types of financial markets, one is a stock exchange, is a financial market, where this when it comes to stock exchange, it could be a primary market as well as secondary market. It could be like a foreign exchange market, could be a derivative market, could be a commodity market. So there are different types of classifications of markets here. So when it comes to stock exchange, why do I say primary as well as secondary? Primary market is when the company kind of trades in their stock to a certain set of investors. So the secondary market is when, a person, an investor who bought in these shareholders sells what they have to another investor. That is the secondary market. All those are included in the financial market. And there are things like foreign exchange markets where they are like exchanging foreign, different currencies. Okay. So a person who has USD will try to, kind of exchange it to the British pounds or the euros. So that is the foreign exchange market. And derivative market, as you know, obviously, the derivatives will be sold here, and commodity markets as well. So financial market is generally where financial instrument, as you can see, are kind of transacted. So when it comes to these financial markets, its physical existence is not exactly compulsory because most of it would obviously function electronically. So as you know, stock exchange being stocks are not something that is like a physical good where you can just go and buy, right? So it is basically happening electronically. And even when it comes to foreign exchange markets, that is something that would happen, and derivative as well. So basically, most of these financial markets would happen electronically now with the ITUs, so that anyone in another country could buy in something in another country as well. That's why things such as Euro bonds are introduced, where different, like Euro bonds are included, where you kind of sell bonds in a different country using different countries' regulation as well, because everything now the world kind of functions in electronically as well. So now, because we were talking about financial markets, now we are going to look at the characteristic of a good financial market. So which market do you say is like a good financial market? One would be to have liquidity. That is where, there should be availability of adequate number of buyers and sellers. Obviously, there should be buyers and sellers. If you have a adequate amount, obviously, that means it's a good financial market. Then it is the information efficiency. What is information efficiency? This is where the buyers and sellers would have access to kind of similar kind of information. So information access is similar for both parties. So then it is called information efficiency. The third characteristic of a good financial market is to have low transaction cost. So what is transaction cost? To the cost that is involved in, involved with regard to buying and selling in the financial market. Why do we need to have low transaction cost? This is in order to ensure that there would be greater participations of buyers and sellers, because as you can see, one of the main good characteristics of a good financial market is to have a lot of buyers and sellers. In order to do that, we also try to have a low transaction cost. Thereafter, the last characteristic of a good financial market, as you can see, is the price continuity. So basically, a market should just have like sufficient depth that the prices are kind of maintained for a particular period of time and for a large amount of transactions. Very important. So price continuity, or market having specific depth so that the prices are kind of maintained in a particular time, and having a large amount of transactions is, for when it comes to large amount of transaction, it's very important for to have in characteristic actually in a good financial market. So so when it comes to a financial market, can broadly be classified into two sections. it could be the monetary market. Thereafter, it could be the capital market. So the thing is, we could talk about money market and capital market, but as you can see, that involves a little bit of explanation. It is a specific area. So I would like to stop today's lesson here. So before moving on with it, I thought it would be fun if we can just do the normal recap as we always do. So first, what did we learn today in our session? We talked about investment, what an investment is, general what investment is, and then we talked about what are the objectives of an investment, why does a company or an individual invest in a certain investment, and then the motives, and we spoke about investment cycle and how the process kind of worked, where we talked about searching opportunities in what according to the strategic plan, then having a outline and appraising financially, looking even at the social side and all that, and then having the budget prepared, and then after including everything, after the whole project is finished, how the budget is checked with the actual, and then how monitoring is kind of done and review is done post implementation, how it would be used in order to get in order as like kind of like a learning for the organization for future projects. So that was kind of explained in basic steps here, where we talked about how the information is gathered, how the predictions are built upon, and how the project is accepted and implemented, where we talked about 2 stages, and then evaluated obviously using the budgets, and then how the knowledge gained is used for the future project. And then I talked about post-completion audit, which is one of the most important things that is done after project in order to take in the learnings of the project for the future project. And then we talked about IT, how IT and strategic planning will kind of help in an organization, how we can invest in IT. Then we talked about market efficiency. We spoke about efficient market hypothesis and the 3 topics. And then the money, we started on with the money market investment, where we spoke about market, financial markets, characteristics of a good financial market. So to next session, we'll obviously be talking about the 2 sections, which would be the money market as well as capital market. I hope you have a good understanding. Thank you, everyone. I just hope